Hey everyone, Tom here. Wanted to do a quick video off a question I got earlier this week, and it had to do with stock or options. So I'm going to show you two opportunities that popped up over the last couple months. One was a winner, one was a loser. I want to show you what happened to the stock or ETF and what happened to its at-the-money options at the same time, so you can get an idea whether or not stock makes sense or options make sense. So let's start off with the trade I have right here in front of me. This is GLD. And what I'm looking at is the money calendar gave me a buying opportunity in GLD. And it said basically from March 1st to April 8th, there is a bullish opportunity. And basically 9 of the last 10 years, that bullish opportunity has worked. Now, last year, it worked extremely well. In 2023, it worked extremely well. But even going back, the only time it lost money was in 2014. So I'm looking at this. I'm adding in the fact that back in these days, GLD was a lot less expensive than it was now. So the percentages of it being right are somewhere in the double digits, in the low double digits. So I take that information and I say to myself, all right, if I took this trade on March 1st and I ran it all the way out to April 8th, what ultimately happened? Okay, so the first thing we can do is we can take a look at it as a stock trader. Let's look at the stock. So the stock's going to cost me to buy the stock on March 1st. We're talking about buying GLD. 100 shares of GLD are going to cost $193 a share roughly. That's $19,300 as I see right here. All right, so that's not cheap at all for 100 shares of GLD. So we're going to come back to this and see what it did. But I do know that as GLD goes up and down a point, that becomes a profit or a loss on a dollar by dollar basis by the number of shares of GLD I hold. How about options? Take a look at the option trade. You can see here that if we were to look at an option, what I'm doing is I'm going back and I'm looking at the end date. Okay, so if the pattern runs all the way out to April 8th, I need at least April 8th expiration in order to trade the options through the entire pattern. So what I ended up doing was taking the April 19th options. The reason why I like April 19th is because even though there are weeklies, and there's weeklies that expire on the 12th, the ones that expire on the 19th have much more volume and much more liquidity, so they're easier to get in and out of at a decent price. So with the April 19th, I have several different options to choose from. But if I were to take the 193 calls, that's what we call the at-the-money option. It's closest to where the stock's trading at right now. And it would look something like this. So the 193 calls with an April 19th expiration on them are trading around $3.85. That means that if I buy that call option, I'm going to spend times 100, because one contract's good for 100 shares, $385. So for $385, I'm able to control $19,300 worth of this ETF. Now, it sounds great already. And in this case, the trade actually works out. So it actually works out really well. So let's fast forward. Now, April 6th or March 6th I have. So this is only a couple of days later. And I picked up March 6th because I want to show you something. Look at what happened to the options on March 6th. They went from around $385 to $7.80 by 8. That was a $405 profit. I took that because that's a double. You've already doubled those options. So, one of the things that I believe in is when you double an option trade, at the minimum, sell off half of it. Now, in order to sell off half, you have to have more than one contract. But by selling off half, you're taking all your money back in the table, and now you're playing with somebody else's money. So where was the stock at this time? So at the time, the stock was trading at around, it was higher than 193. It was around 198.79. So the stock was up $579, but that's only a 3% return on the ETF itself. Now, I want to run the next chart all the way out to, if you held the rest of it, all the way out to April 8th, which was the final day of the pattern. How did it turn out? Well, final day of the pattern, if you held just GLD, or you held those options themselves, you would have had a 518% profit. because your $385 returned a profit of $2,000 or nearly $2,000. That meant the $3.85 options on the final day of the money calendar pattern, 2370 by 2390. That's absolutely incredible. And this is one of the biggest runs that we've seen in gold in years during this time frame. So it definitely shows that holding the option made more sense than the stock, because the stock, even though the stock returned more money, it was less as a percentage return on risk, because you took a $19,300 instrument and you made $2,350 with it. All right. But with the option, you took a $385 instrument and you made $1,995. That's where you come up with the 518% return versus the 12.2% return. So very, very good example of when the options make sense. Now, let me show you another one. This is the S&P 500. It had a money counter trade, bullish trade, buy on April 1st, sell on April 26th. Now, any of you that have been following the markets, you know what the S&P did in April. It pulled back for a good bit of April. So let me just show you what's happened. Buying 100 shares of SPY going to cost you $52,200. That's $522 a share times 100. Instead, how about the options? The at-the-money options with an April 26th expiration date on them going to cost you $744. So $744 to control $52,000 plus worth of ETF. Looks good so far. But if you fast forward to April 26th, you're going to see that your $52,000 investment, if you owned SPY, decreased by $1,374. That was a 2.6% decrease between the start date and the end date of this seasonal pattern. The options, well, they expire worthless, which means that the $744 that you put into this trade, gone on April 26th, because that was expiration day, and those at-the-money options became out of the money. The only silver lining that I see here is, even holding these options, you end up losing less money on a 1-to-100 basis than you lose $744 versus $1,374. So I wanted to show both a winning combination and a losing combination on, do you own the stock or do you own the options? If the stock goes up big in question, obviously the options are going to make more money on a return on investment than the stock. And if the stock goes down big, there's only so much you can lose on an option themselves. Where the options don't make sense is if we just go up a little or we go down a little, because you could end up losing more on a dollar basis on the option than you would on the stock. So each stock, each pattern is different, and it's up to you and I to determine which ones are the best to take in any circumstance. I hope that helps explain this a little bit more. Thanks for watching the video. We'll speak soon. Bye now.